Are you starting for Level 1? Watch this essential guide. Exam focus questions and answer. Video number 6.
Welcome to the Chartered Financial Analyst series of videos. As usual, I provide a short slide about my qualification and experience. Today we will continue with the topic of corporate finance and equity. This is the video number 6. On the topic of corporate finance and equity, we are on the second topic, which is capital budgeting. We did this in previous videos, and this is the video number 3 on this topic. Today we will continue our criteria for evaluating project for investment. In the previous videos, we looked at the net present value and then the IRR and the other two methods. Today we have the fifth method, which is the average accounting rate of return. If the average accounting rate of return is higher than the cost of capital, we will take the project, and if it is not, we don't take the project. And let us see an example and the formula for calculating the average accounting rate of return. Don't forget always the word average. The average accounting rate of return is simply the average net income over some years, normally 5 years. You take the net income the company achieved in 5 years and divide by 5, you get the average net income, and then you take the average book value. You have a book value at the start of the project, and you have a scrap value at the end of the project. If the project initial outlay costs the company $10 and it has a scrap value after 5 years of 2, that means we divide 8 by 2 to get the average of 4. Let us take a numerical example. We have a company that invested $200,000 in a project, and that will be depreciated over 5 years, and it has no scrap value or salvage value at the end of the 5th year. So we are going to consume or depreciate the whole amount. I'm talking now about depreciation because we are talking about accounting rate of return. Normally in finance we follow the cash flows, but this one of the old method of evaluating the project. We take the accounting, not the cash flow. So we will have to account for depreciation. It's a normal profit or loss account. Let us see, we have 5 years and we have the sales, 100,000, and these are the figures of the sales, figures of cash expenses, and then the depreciation. We are going to deduct all these expenses from the sale to get the net profit. Earning before taxes, always we take after tax cash flows. So we have to deduct the tax at the 40% for this particular company. Note that the earning at the 5th year was negative, and the tax is negative also, not positive like the others. That means it is it's a tax credit, and it will minimize the loss from 10,000 earning loss to 6. Let us see the net income, and now the net income is only 6,000, not the 10,000 because of the tax credit. The average net income is normal. We add all these profits for the 5 years, and we divide by 5 to get the average of 18, and then we minus 200 from the scrap value, which is 0, and divide 2 to get the average book value. We are talking about the average. So 18 divided 100 gives 18% accounting rate of return. We should compare this with the normal average return we take and decide whether to take the project or not to go ahead with the project. The sixth measure or criteria used for evaluating new project or investment is called profitability index. Before we see the formula, I want to make it very simple. The terminology look very complicated, but the idea is very simple. profitability index. What that means? Let us assume that I invested only $10 and I expect in the next 5 years to get cash flows that has present value of let us say $12. So I invested 10 and now I have present value of all the cash that are going to come from the project equals 12. So I'm increasing the value from $10 I invested to 12. Profitability index is simple as the $12, the new value, divide the initial outlay which I paid. If it is more than 1, definitely the project is acceptable. So the profitability index look very complicated, but it is so simple. The present value of future cash flows, which we say or assume as 12, divide the initial outlay or the investment I made, which is 10. 12 divided 10 will give more than 1. So the project is okay. But if the future present value of the future cash flows is only 8, that means 8 divided the initial outlay 10 will give a value of less than 1. So the project is not feasible. So it is simple whether the future cash flow is more than what I invest now or not. If it is more, we'll get more than 1, the project is okay. If it is less, then we get less what we paid initially, the project should be rejected. So if the project profitability index is more than 1, greater than 1, we take the project. If it is less than 1, we reject the project. There is a new term called net present value profile. We know what is net present value, but what is meant by profile? Profiling the net present value, that means looking at different scenarios. If we increase the weighted average cost of capital or the discounting factor or the required rate of return, if we increase it from 1 to 2 to 5th to 10th to 20, what profile we'll get? Let us take example, numerical example in a table. The profile shows a net present value graph as function of various discounts. So we have various discount assets, 2%, 5%, 7%, 8%. We keep increasing the discount rates. We expect as we go higher, the net present value will be lower because the higher the required rate of return, that is the discount factor, we will get a lower value from mathematical point of view. If you remember the golden rule or the golden formula I have mentioned in the first video. Let us see the profile. This is a discount factor, assuming 0 discount factor. The net present value will be 34 million. Now, if I increase it to 5%, the discount factor, the net present value goes down to 12. If we increase to 10, it goes down to 3. Until we reach this figure, the net present value will become 0. If you remember, the IRR, the internal rate of return, is the rate of return that makes the net present value equal 0. So this is the internal rate of return of this profile. Now, if we go beyond that higher, the net present value turns negative and so on. So the higher the required rate of return or the higher the cost of the capital that I bring in the company to use and invest, the lower will be the net present value. That is why we should always aim to have very low cost of capital so that our net present value become higher if we have low cost of capital. But if you have 30% cost of capital due the company having very high risk, investors are not willing to further fund to the company only at a very high rate of return, then we are losing money and our value will become 0. Why we increase it? We explained this in the first video, but for mathematical point of view, you remember this golden rule I always bring in. Whatever cash you get, if you divide by a figure higher, you'll get a lower value of this fraction. think of it just mathematical point of view. So if we increase it from 5 to 10 to 25, we increase this one. So this fraction will become lower. The net present value, as we seen, is having future cash flow 1 plus r to the power of n and the number of years. We explained this in the previous video, video number 5, why we introduced the a, because here we set only rate of return r. Now we are introducing 1. Why we're introducing 1? We answered this question in the previous video number 5. Now we are going to show these figure as graph. The discount factor will be in the x-y and the net present value will be in the y-axis. Let us see it and see what profile we'll have. Here we have a very low discount factor, 0. We will have very high net present value. This is the net present value, 34. If you remember from the previous slide, it was 34. Don't forget this 19.52, which makes our net present value equal 0. Let us go back to the profile. This is the 34. We increase the required rate of return or the discount factor. It goes down from 34 to approximately 22. And now we go on and on until we reach a net present value of 0 at the required rate of return of 19.25. This is the net present value equal 0. If we increase it further, the net present value goes negative. This is what is meant by the net present value profile. We can see inverse relationship between net present value and the discount factor. The higher discount factor, the higher the cost of capital, the higher the required rate of return, the lower the net present value. If we want to create value to the company, we must decrease the required rate of return or the cost of capital by getting loan at a very low interest rate, by reducing the risk on the company overall, so that equity investor will ask for lower required rate of return, and hence we as finance manager, we create value to the shareholders. This is the IRR at 19.25 internal rate of return, where the net present value is equal to 0. Sometimes we will have some conflict between the net present value calculation and IRR. Sometimes you get net present value higher but lower IRR in one project, and the other project will have lower net present value but higher IRR than the one, the first one. So if the two projects are mutually exclusive, you have to choose the net present value, because this is the real value ultimately you are going to create to the company as a whole, regardless of whether you are getting it at IRR of 10 or 12 or 13%. At the end of the day, the company value there or the equity value in the market will theoretically increase by the net present value, not by the IRR. The conflict always arises if we have unconventional cash flows. But if the conventional cash flows is there, there will not be any conflict between the two. What we mean by conventional and unconventional is that the conventional cash flows is always have a negative figures at the early years, year 1 or 0, and then subsequently always we get positive net cash inflow from the project. But the unconventional or non-conventional cash flows is, we will see positive and negative sometimes. In the first year it is negative definitely, because this is the initial outlay. You invest it and you pay money, so you'll have negative cash flow. Then in the second year or the third you'll have positive, and then again in the fourth year or the fifth year you get another negative. This is the unconventional, where the conflict may arise. So if you have, as I said, two mutually exclusive, the conflict will be there, because if you want to take one project out of two, so are you going to use the IRR or the net present value. As I mentioned, we should use the net present value. But if the two projects are not mutually exclusive, that means you can take both of them, then it doesn't matter whether the IRR are different or not. Since both the net present value are positive and I can take the two projects, then you will go ahead with two projects. As I said, one project might have net present value higher but lower IRR. Let us see an example. We have these are the years. Project A will have negative initial outlay of 200 million and net present value of 53, IRR 21%, which is very high. I want you to notice that in year 1, 2, 3, 4, we get a steady cash in positive at 80. Let us see the profile of the project B and how different it is from this, and what conflict will arise and how we deal with it. Let us see project B have the same initial outlay, but there is no cash in or out in year 1, 2, 3 until the year 4. But then at that year you get very huge cash inflow. So the IRR is very high here because the cash flow is assumed to be reinvested. The cash flow I receive here is reinvested here. Then we add the cash flow of this and reinvest it again until the end of the year 4. This is why you'll have higher IRR. Here there is no cash in so that you can reinvest it. That's, as I said, the net present value model always assume that we reinvest whatever cash we get during the life of the project. Here there is no cash, so there is no reinvestment. That's why the IRR here is lower than this. But ultimately, this is the value that will be added to the company, not this one, which is lower. Hence, we should always opt to take the project with the higher net present value, not the one with the IRR. So whenever we have the net present value two mutually exclusive, as I said, but if the projects are not mutually exclusive, we can take both of them, then we can take the 53 and the 73 regardless of what is the IRR. But if they are mutually exclusive, that means I cannot take both, then I will opt for this one because this is the ultimate value that will be added to the company. This is the last slide, and it is about the IRR problem and the no IRR problem. In certain cases, we will not get any IRR because of the non-conventional cash flows. The non-conventional cash flows, this type of problem will appear always. The non-conventional cash flows, as I explained earlier, we will have negative, positive, and then again negative. The multiple IRR will not occur in conventional cash flows. That is, have initial cash outflow negative, and then subsequently all are positive. In this case, we call it conventional cash flow. There is no multiple IRR, and there is no issue. Corporate usage of various capital budgeting methods. Why always the net present value is preferred? Let us take this example of this company which is invested $600 million initial outlay. So this is a negative figure, and it has a net present value, present value after tax equal 850 million. That means I invested initially outlay negative cash out 600, and then I got 850 present value. That means if you remember, the profitability index will be higher because 850 divided 600 will give more than 1. So we'll have a positive net present value of 250. From 600, now I have a value of 850, so I gain 250 million. But the company has 200 million shares. The market price is $32. So $32 times 200 million will give the market value of the company. So we want to evaluate what impact this project theoretically will have on the share price. It should increase the value of the company theoretically. Let us do some calculation. Do not forget the 850 present value and the 600 initial outlay in the next slide. This is the present value, 850. I will deduct the initial outlay of 600. That will give me the net present value of 250 million. This theoretically should be added to the equity value in the market. Let us see whether this will happen or not. Now, the value of the company before taking this project is $32 per share into 200 million share outstanding. 200 million share times $32 per share in the market. So the value of the company, 600, or let us say it is 6 billion point 4. We should add the 250 million from the new project as a new value added to the existing value. 200 we add it, we get theoretically again a value of 6650 of the company. We should divide this by the number of shares to get new value for the share, which is 33.25 compared to the previous value of 32. So we created value to shareholders by investing in project that has net present value that is positive. So the conclusion from this calculation that if managers can invest in projects that has positive net present value, in this way they create value to the owner of the company who are the shareholder. And this explains why the net present value is widely used in corporate companies to evaluate their project. This will take us to the end of this video. The next video will be about answering some questions, exam type questions. So it will be a very short video. We cover the capital budgeting, and then we move on to my favorite topic of the capital value of the company, how to evaluate it. So using the weighted average cost of capital. So the next video will start with the cost of capital, which is a very interesting project and topic. You will find it everywhere in level 1, level 2, and level 3 in this course.